Good evening, everyone. I hope all of you are doing good. So, your friend, Chartered Accountant Manobha Verma, back again onto the last leg of working capital management. I hope each and everyone is doing great and looking forward for some action for the evening. And I'm pretty sure, looking at the excitement from the query panel already, and a lot of student messages already coming in, uh, I can feel that you guys have done a little bit of a homework. You guys have done some practice with respect to whatever we did in the last lecture. We talk about different models. We talk about the working capital management. We talk about the cash budget. I'm sure you guys did some practice on the cash budget, types of floats, and we started Saturday session with a lot of excitement. We ended with a very, very important aspect of management of receivables. I hope you remember we talked about three critical aspects of receivables over there, where we were talking about credit policy, we were talking about the due diligence, and we were also talking about the control of receivables. And as far as the credit policy is concerned, we were talking about the some credit terms which are pretty much evident in terms of various agreements between vendors and customers. Just like an example we discussed, that is like 2 by 10 and 30. That means the credit period is a kind of a 30 days, but if you're paying within the 10 days, you're getting 2% discount over there. Now, we also talked about with respect to the due diligence that yes, you would definitely continuously want to do a little bit of a customer background check in terms of the risk analysis, because we will be talking about the profitability versus liquidity today. We will be talking about the evaluation of the credit policies. And not only that, we talk about the internal monitoring tool with respect to the aging analysis, that yes, how you would be wanting to follow up with various kind of receivables, how you can monitor the adequacy of the provision for doubtful debts. So these are the very important aspects of receivable management. On one hand, you want to increase your revenue. You are pretty much interested in increasing the receivables, so that and the way to do that is probably have a lenient policy in terms of the credit. But the problem is that could, on the other side, could result in a bit of bad debts. But on the hindsight, if you want to have a faster collection, you want a low number of receivables, that's good for liquidity. But what about the customers can shift to the competitors? I hope each and everyone remembers this part when we discuss this towards the end of the session. So just to give a short recap. So today we wanted to start our discussion with approaches to various credit policy evaluation. How does the organization decide which is the best policy, whether it is the present policy or it is any of the proposed policies? For example, presently you are giving a credit period of 30 days to various customers. Now, the option is probably you want to evaluate 45 days, 60 days, or 90 days. I am sure you guys understand, as more and more number of days you want to provide with respect to your collections, your sales may increase because customers may find a lot of comfort in your lab, because you feel that yes, probably I'm getting some time. This is everyone here is an expert in operating cycle, right? Working capital cycle. I'm sure all of you remember, because from the perspective of our customers, you are a vendor to them. And probably more credit period, more comfortable they are, and hence your credit sales will increase. But to what, at what cost? You want to increase your credit sales? Very good. There are a couple of problems attached to that. One, definitely, probably the bad debts. Second is to increase that sales. Is there any opportunity cost attached with that? Yes, it is, because your debtors would definitely include some investment. We discussed that. Cash cost involved in the debtors. Your working capital is stuck up over there. You could have invested that amount somewhere else, earned something more. That acts as an opportunity cost. So the idea is how we will be doing the evaluation of the base credit policy here is to ensure first we take care of what are the scenario in the present policy. Let's say what are the credit sales here, what are the variable and fixed costs, bad debts, because bad debts will definitely grow a little higher as you want to increase the number of days. And then probably you also consider the opportunity cost, and you will evaluate the net benefits under each of the policy, present policy and proposed policy. My question, the first question of the evening to everyone here is, guys, can you tell me what will be your decision scenario here? That's okay. I've calculated net benefits under all the policies. That's fine. But what will be your decision criteria? Which policy do you select? So let's see who want to respond first today. Is it Smitha? Is it Siddhant? Is it Banredi? Or is it Hitesh? So a lot of students already action. I'm sure you guys are ready for the answers here. How do we decide which is the best policy? Any idea? On what basis we decide that? I'm looking at your responses, guys, on the query panel. Again, I'm repeating, what shall be your basis of deciding which policy is the best one? Hero says 45 days. Hero, on what basis? My question is, how do you decide? It could be 45 days, it could be 60 days, it could be 30 days. Present policy could also be best. But here my question is, what shall be your decision criteria? Like in investment decisions, we discussed, various capital projects are having a more NPV positive. But when it came to multiple projects, we used to select the projects with the maximum NPV combination. So don't you think this is the scenario? Well, let me wait for the other answers. Hitesh says present should be the base, okay. But Siddharth gave me the perfect answer. Siddharth says higher net benefits. Guys, don't you think your decision scenario will be based on this bottom section? The net benefits, whichever policy proposal shall give you the maximum net benefits, you should go with that. Am I correct? At the end of the day, you want to, probably maximize your benefits, right? Net benefits, benefits net of any opportunity cost. Absolutely, Siddhant. Smitha, perfect. Smitha says sales revenue increase with minimum risk of bad debt. But Smitha, quantification can only be done with respect to the net benefits, right? That's what we are discussing here. Yes, Shakti also said net benefits. Great. So the idea here is that, we will be evaluating. We'll be doing some practice also. Now, Gayatri gives me a suggestion that, okay, why don't we give a debtor who is a regular customer? So I'm reading out, Gayatri's point here. A customer who is kind of a regular customer for us, can we give more credit? Yes, we can. See, generally there could be customized policies also. Let's say for some debtors you have policy 1, for some debtors you have policy 2. That's okay. But now what we are about to discuss is some important points in this evaluation. First important point mentioned at the bottom. Guys, your fixed cost generally doesn't change amongst policies. Do you agree with me on this? Unless and until you're operating in the present capacity, you don't want to go for expansion, you're not setting another factory, your fixed cost will be same. And how do I calculate my fixed cost? For example, if they're giving you let's say the selling price per unit, they have or probably you have a total cost per unit. So your total average cost per unit minus variable cost will give you the fixed cost per unit. And that fixed cost per unit will be multiplied by the number of units under current policy, because that will be your current fixed cost. And mind you, the current fixed cost will be fixed under the other policies as well. So fixed cost will be fixed, right? That's what everyone understands. And what is opportunity cost, guys? Total cost of sales. We'll talk about this little later, whether we are including cash cost if the information is given, into collection period upon 365 multiplied by required return. That is interesting. Guys, just tell me one thing if you agree with me or not. If I would have invested the cost of sales somewhere else, there is a required rate of return, opportunity cost. Would I have got annual number? Yes or no? The return I would have got would be annual rate. Am I correct, guys? But the credit policy be for certain number of days. That means we should compare the opportunity cost only for that period. Am I correct? So if it is 45 days, we should multiply that by 45 by 365. Guys, do you agree with me on this? Very logical, right? So we calculate the annual return and we multiply with the credit policy period. So opportunity cost would be higher for a higher credit period. Am I correct? Longer the period, higher will be the opportunity cost. That's it. Am I correct, guys? Now, one important aspect more I would like to talk about. There are two ways to look at it. I remember, I think, was it Hitesh? Someone replied me. Yes, Hitesh's reply was almost 5 minutes back that my present should be the base. Now, one way to evaluate these policies, credit policy, is to have a gross approach. I am doing the total calculation at each level. Present policy, policy 1, policy 2, policy 3. And I'm doing entire calculation at a total level. Total credit sales, total cost, bad debts, it's everything total. But there could be a scenario we can also decide the same based on incremental approach. Where Hitesh, what you said, we will be doing that. That we will take the present policy numbers and we will take only incremental numbers for subsequent policies. Policy 1, policy 2, and policy 3. So the difference between this table and the last table is there every evaluation was done at the gross level. What will be my total sales? What would be my total cost? But here what is happening is, let's say my credit sales under the present policy is, let's say guys, 20 lakhs. And as I change my credit period to, let's say, from 30 days to 45 days, and I say my sales becomes 25 lakhs. Now, under the gross approach, I would have mentioned 25 lakhs, but here I will only mention 5 lakhs. The differential. Let's say proposed policy 2 says 32 lakhs. So I will talk about 12 lakhs and so on. Guys, everyone with me on this? Can you please confirm? So here, every number, be it of sales, look at this. Incremental credit sales. Incremental cost. Generally, the fixed cost incremental could be 0. In most of the circumstances, it would be 0, right? Because the fixed cost remains same. So that's okay. You can call it that, but I'm more comfortable with incremental word because you will be, kind of taking that difference from the base number, right? Incremental bad debts, incremental cash, everything is incremental. So what we are talking about here is, at the end of the day, we get the incremental expected profit after tax. That's incremental expected profit. And then we calculate the required return on incremental benefits, incremental investments. Now, what is that required return? We know opportunity cost, right? Is it the opportunity cost? So I will do that. I will start with cost of sales. And then the subsequent cost of sales will be incremental here. We are talking about the collection period, incremental collection period. And then we will be talking about how much is the investment in receivables in terms of the total level and probably as an incremental level. We will eventually get the incremental net benefits. Now, very interestingly, what will happen in this case and in the total approach? Do you agree that the evaluation would be same? Decision should be same, guys? Yes or no? Gayatri says increase in present policy days is incremental, not increase in previous policy. Gayatri, you are talking about increase in the present policy days, right? So basically what we are talking about here is in terms of the required return. So if we are talking about increase in the present policy days, then we are just comparing that on an incremental basis. So present policy days could be 30 days, right? So, and the new policy could be 45 days. So what we will do is, we will first calculate the investment in receivables at point number C on the right hand side. Everyone with me on this? Guys, everyone with me on this? We are talking about the incremental policy or the incremental receivables only if we get the numbers A, numbers B. And then we talk about the incremental investment. So let's say the receivables in plan A is, let's say, 5 lakhs, but the receivables in plan B 6 lakhs. So that means incremental investment in receivables will be 1 lakh here. That's what we're talking about here. Here it says not understanding the difference between the total approach and incremental approach. Here, my question is, if you are computing the net benefit, let me give you an example. Anyways, we'll be for solving a good comprehensive question here. Here, this is for you. Let's say current policy gives you a net benefit of 20,000, and let's say a proposed policy gives you the benefit of, let's say, 27,500. Yes, Smita, I agree. Smita says the incremental is just an incremental number to compare, but the evaluation will be same. So, Hiral, do you agree with me that in case the proposed policy will be selected 27,500? Hiral, that one is okay for you? I'm not giving the calculation right now. We'll be solving a question together. If it is an incremental approach, what we will do, Hiral, here is, in the case of incremental approach, we will mention 20,000 here. However, we will mention only 7,500. Does this make sense? So that means if we are talking about incremental benefits, let's say 7,500 here, 9,000 here, and let's say 8,200 here. So we'll say that, okay, the incremental benefits in proposed policy 2 is highest. Let's select that. So don't worry. If you guys are feeling overwhelmed with a lot of information on the table, let's attack illustration here. Everyone with me on this? Let's attack this. I want everyone to be fully concentrating for the next 20-25 minutes while we are working around in some good calculations here. And I want everyone to participate as you always have been. So a trader whose current sales are in the region of 6 lakhs per annum. Now we are talking about current, guys. That means at present, my sales are in the region of 6 lakhs. Average collection period is 30 days. So what is my present policy, guys? 30 days. You want to pursue a more liberal policy to improve the sales. And they're giving you the proposal for with respect to 4 policies. A, B, C, D. Increase in collection period. Wow. So that means at a total level, it will be 40 days. In policy B, it will be 30 plus 20, 50 days. It will be 60 days and it will be 75 days. Increase in sales. So by the way, the number is already given in the incremental format. Here, did you notice? What I'm now doing is I'm taking it into a total approach. The numbers in this question is already given in the incremental scenario. So for example, if the sales is 6 lakhs, the total sales is 6.30 or 6.48 or so on. What do you think, guys? Everyone okay here? Everyone with me on this? So we're talking about 6.48 or we are talking about 6.75 or we are talking about 6.90. Guys, let me know if any doubts till now. Just looking at the query panel for any doubts. Great. I can see the lot of anxiety already building up. So I am very much interested that, okay, the sales are increased. That's amazing. But unfortunately, the bad debts also increasing. Right? What they have given us is selling price is 3. Average cost per unit is 2.25 and variable cost unit are 2. Current bad debt is 1%. Wow. Current bad debt is 1%. Now, my first question to all of you is, What is the current or total fixed cost here? Can you please tell me what is the total fixed cost? Total fixed cost, guys. Waiting for your response in the query panel. They says 50,000. They says 50,000. What about others? And how are we calculating the fixed cost? That would be also good to know. I'm sure many, if you're evaluating that, okay, the sales are 6 lakhs. So probably the units are 6 lakhs divided by 3 is 2 lakhs. Right? So then we're talking about 2 lakhs multiplied by the fixed cost per unit, that's 0.25. How did I get 0.25? That is 2.25 minus 2. And hence it is 50,000. Everyone okay here? I think we got what we need to know, right? Is everyone ready to go through the total approach, guys? I hope everyone ready for the total approach. So let's walk through this. I'm currently focusing only on the present policy, guys. I'm only focusing on present policy. 6 lakh is given to us. Now variable cost was 2. That means out of 3, it is 2 by 3. Variable cost is sales into 2 by 3 because my selling price is 3 and variable cost is 2. 4 lakhs. Fixed cost we all calculated. Bad debts currently is 1% here. So 1% of sales. 6,000. And expected profit is 1,44,000. I am very much interested in calculating the opportunity cost. Now, in opportunity cost, we're talking about cost, not the selling price. And the cost is 75%. Do you agree with me? Cost is 75% because 2.25 upon 3 is 0.75. And that is why my cost is 4,50,000. Anyways, you could calculate the total of variable cost and fixed cost. That can also be done, which is already for us 4,50,000. Right? That's the total cost. So 4,50,000. If I would invest at 20%, mind you, the required return is given to us in the question is 20%. So 4,50,000, if I'm investing at 20%, I'm getting 90,000. But guys, this is 30 days only. 30 days, but that means 1 month, 30 upon 360. That is, we are getting 7,500 as opportunity cost. Hence, we are getting net benefits as 1,36,500 in the proposed policy. Any questions till now, guys? Is present policy clear to all of you? Present policy. Let me just quickly check the query panel. Any doubts till now? Hitesh says all clear. Very good. In fact, there are 2 types of all clear, right? One is all clear and one is all clear. I think the first type of all clear is more important when everything goes inside the head rather than over the head, right? I hope everyone is getting inside the head. Okay, so we move on to so I will be talking about 2 policies here, and I would expect you guys to go through the other 2 policies later on. So let's move on to the 40 days policy. So let's move on the 40 days. Okay, I have a question in the meantime from Siddharth. How did we get 4.5 lakhs? So there are 2 ways. Are you understanding? Variable cost of 4 lakh and fixed cost 50,000. So that part is clear. The total of 2 is 4,50,000. One is simple way. You already did the hard work, right? Variable cost 4 lakhs and fixed cost 50,000. And Siddharth, anyways, your selling price is 3 na, and your cost is 2.25. So that's 75% of the sales. Yeah. So let's go to the 40 days, guys. Now, in 40 days, my sales were increasing 30,000. Okay. So this is my sales, 6,30,000. Variable cost proportion per unit remains the same. So accordingly, it will increase. There is a 5% increase here. So 4,20,000. Fixed costs remain the same, by the way. Please remember, unless until they give you any kind of a capacity constraint, the fixed cost will always be 50,000 here. Gayatri says, why is variable cost calculated like this? What do you mean by calculate like this? Variable cost is given to you, right? Gayatri, variable cost is given to you too. Or you can calculate units then. That's fine. If you want to calculate units, you can calculate units now. So probably if you are Gayatri, if you want to are comfortable in calculating the units, you can do that. 2 lakhs here, 2,10,000. So I am dividing the sales by 3. 2,16,000. This is 225, I guess, and that is 2,30,000. Gayatri, is that okay now? So either you could have done 2 by 3 of sales, or you multiply 2 by the number of units. I just tried to save your time. Okay, guys. So your sales minus variable cost minus fixed cost is done. The total cost is 4,70,000 here. And then bad debts. I think bad debts got increased, right? 1.5% it is. 1.5%. So 1.5% of 6,30,000 comes to 9,450. And hence your expected benefit is 150,550. So sales minus variable cost minus fixed cost minus bad debts gives you 1,50,550 here. Now, the crucial point, calculate the opportunity cost, guys. Everyone is with me that my total cost here is 4,70,000, guys. 4,20,000 variable and 50,000 is my fixed cost. So, agar we invest 4,70,000 into 20%, you get the return for annual piece. But since my credit policy is 40 days, we will be taking the return only for 40 by 360. And my opportunity cost comes out to 10,444. Hence, therefore, my expected profit, which was 1,50,550, I reduce the opportunity cost, and hence I get the net benefit of 1,40,000. You can see the jump here. You can see the jump. Gayatri, Pooja, anyone wants to ask any questions? Are the first two, the present policies and 40-day policy is clear to everyone? I will be talking about one more policy then. I'm not talking all the 4 policies. You guys can do some calculations later on for third and fourth proposed policy, C and D. Okay, can we move on to the 50 days then? Can we move on to 50 days? Everyone okay? Now, in 50 days, what was happening is my sale got increased by 48,000 here. That means my sale is 6,48,000. Again, 2,16,000 into 2, my variable cost. Fixed cost remains same. That means the total fixed cost, total cost is 4,32,000 plus 50, 482. That will be important for opportunity cost, guys. Look at that at the bottom, 4,82,000. Bad debts again got increased. See, longer the policy, chances are bad debts to be increased. Now it is 2% here. And this is 2%. It's not incremental, right? 2% given to us. So 2% into 6,48,000 is 12,960. which gives me expected return of 1,53,040. And because my total cost was 4,82,000, my total cost was 4,82,000. If I invest it at the rate of 20% for 50 days, I'm getting opportunity cost of 13,389. But I can see the problem here. What has happened is, as I increase my policy return from 40 to 50 days, probably bad debts increased a bit, and I can see the expected profit less opportunity cost went down from 1,40,000 to 1,39,000. Everyone okay here? Yes, Smita, perfect. 13,389. So is everyone okay? What happened was it went down. And I can see the subsequent policies were having more bad debts anyhow, 3%, 4%. Initially bad debt just increased marginally, 1 to 1.5, and then 1.5 to 2. But after that is like 1% jump straight away. Similarly, if you do your evaluation for the present policy and the other 4 policies, you will find out the best policy would be 40 days. I am not covering policy C and D. You guys can walk through that later. But anyways, the benefit is kind of going to reduce primarily because of bad debts here. So which policy should we select, guys? Which policy should we select? Can anyone give me the decision here, please? Which policy to be selected here? Okay. Pooja says, I have a doubt in bad debts calculation. Pooja, please ask me which policy you're talking about? Which particular policy calculation you're talking about? Okay. Okay. So students who are answering me that policy A should be selected, absolutely correct. Because that's the maximum benefit, 1,40,106. That's the maximum benefit out of all the policies. But Pooja, the bad debt calculation is pretty straightforward. That they have given you the bad debt percentage in the question. You have a bad debt percentage 1%, 1.5, 2, 3, and 4. You have to just multiply that with sales. So Pooja, just multiply the bad debt percentage with sales. I think you should be doing fine. Can you please confirm if this is okay now or still you are having any doubts? Gayatri says, the Pooja, I have just told you, na, in the question itself, give me a second. Pooja, what is happening in the question itself? You are given the bad debt percentage. Look at the section below the table here. They have talked about the bad debt losses 1%. So 1%, 1.5%, 2%, we are multiplying bad debts is equal to, I'm writing on the top, sales or credit sales multiplied by the bad debt percentage. Okay. Gayatri says calculate total cost again. Gayatri, fixed cost is 50,000. Gayatri, fixed cost is 50,000 for all the levels. It is not changing. And Gayatri, we just mentioned the units on the top. Variable cost is given you 2 per unit in the question itself. Please check the question again. There is mentioned variable cost is 2 per unit. So variable cost is nothing but we're talking about units into 2, or I mentioned sales into 2 by 3 because my selling price was 3. Gayatri, I hope it is clear. So variable cost plus fixed cost is my total cost. I can mention here total cost again. That's what mentioned here on the top, total cost. Siddharth has a point. Sir, we can also say practically if the period is more than required, return would also rise, as in the market rates is more for longer investment. Yes, Siddharth, absolutely wonderful. But I think you yourself answered the second part, that since we are talking about credit policy in terms of days, 40, 50, 60, generally in this short term, your investment rate may or may not change. I think you yourself answered that. But it was a very, very valid point. Smita says increase in credit policy, reduce net benefit. Okay. Absolutely right, Smita. Hiral says how many chance of getting the fund forecast sum in the exam? What? Are you talking about, Hiral, are you talking about the cash budget or what? I think this is not related to this question, right? Hiral, this is not related to the last class at all. Just be sure that psychologically, just make yourself clear that this class, this portion has nothing to do with the last class. Because we are talking about opportunity cost today independently of the last class cash budget. Last class major discussion was cash budget. Okay. Any other questions, guys? Any other questions right now? I think everyone done. Because now, if you don't have any questions, I have a question for you. Everyone has told me that, sir, we should select policy A. But I want to cross question you. And my cross question is, can you guys tell me if I would have prepared this as an incremental approach, what would be the incremental benefit for proposed policy A? I will show you the calculation in a couple of minutes, but I want you to answer this first. What will be the incremental benefit for policy A? So Dhanshu is asking me that in policy C. So Dhanshu is given 3%. Why you are saying 2.5? On what basis? That's okay now. Whatever we have given, we have taken that. So Dhanshu, that's okay. We cannot challenge the question. If it is given, it is given. My question was, I am repeating, what should be the incremental benefit for policy A? And I think the only answer I've got, which I'm liking right now, is Siddharth. Siddharth says, policy A is giving you 140,106. Present policy was 136,500. And hence, it should be 3606. Am I correct? Even Siddharth gave me the same answer. Sudhanshu also giving me the same answer. But Hitesh, you need to check how did you calculate that part. And this is for A, guys. For B, I will say 139,651 minus 136,500. So 3151. Smita, you need to check probably what you have done. Smita, you need to check. I think you might have done some calculation error. Looks like 3606 to be based on the answers given by everyone. Couple of more students, your numbers are not looking good to me, but you can check that. Shakti has given me answer for all. Shakti says Bandredi, your answers are, I think only one answer I received, Bandredi, for you. That was in percentage. That is not correct. 2.64 percentage. Bandredi, 2.64 percentage. I'm not asking you in terms of percentage, by the way. Right now, I'm not talking about percentage, Bandredi. So you need to give me the absolute number. So Shakti has given me answer 3606, 3151, and so on. So guys, if you understand this part, the incremental approach is already done now. Do you agree with me? The only thing is here you are calculating the incremental by the net benefits at the end. But in the incremental approach, we do it from the scratch. Sales will be incremental, cost will be incremental, bad debts will be incremental, even the opportunity cost will be incremental. You're absolutely perfect. But you guys are absolutely spot on. All your answers are good. So this is a way where we are doing it more of a incremental approach. So you can see that incremental sales are kind of 30,000, 48,000, 75, 90. So incremental cost. So everything is incremental here. So variable cost was 4,20,000. So we are only talking about incremental. Not only that, in terms of the bad debts also, we are talking about only incremental bad debts. And then we are looking at what is the investment in receivable required. And then we are just calculating the incremental investment. And on that basis, we are just kind of multiplying the 20% with the policy to get my required return here. So incremental investment is 14,000 and we are just talking about 20% in this case. And hence, we are just talking about in terms of 2944 as required return. So what we have done is, as you guys anticipated, you guys got 3606. But I am very much interested in looking at policy number D. Policy number D is giving you a negative number, minus 5350. That means the net benefit in fact has gone declined as per the present policy. It has gone negative, as you could see in the total approach also. In the total approach also, my present net benefit was 136, whereas the policy D is taking it much down to 131. Yes, I want you to spend just 30 seconds here, 1 minute, 30 seconds to 60 seconds. Let me know if there are any doubts. The presentation is different. We're just doing everything on incremental aspect. The investment is receivable also is done in the incremental approach, because you could see that initially the investment is in receivable is already taken care of the number of days. And we are just looking at the incremental for the purpose of required returns. Someone may ask me that why did not we multiply the number of days when we are multiplying this 14,722 to 20%? Because that number of days appropriation is already considered when we calculated the investment in receivables. So guys, this should sort out your total approach and incremental approach. Let me know if you have any doubts. Any doubts from anyone? I'm giving you 30 more seconds to have a quick look at the same. Okay, so there is one more thing I would like to talk about, guys. If you see the top right bottom section of my screen, there's something called expected return approach. Now, what does that expected return take into account is, they take into account incremental profit and incremental receivable percentage. Incremental profit and incremental receivable percentage. So what's the incremental profit, guys? Incremental profit. In the case of policy A, we talk about 1,50,550. Am I correct? Then we are talking about incremental receivables. So basically what we're talking about here is the incremental profit is, for example, 6550 in the incremental approach. Siddharth says how we got incremental investment in receivables. Siddharth, this is 52,222 minus 37,500. 52,222 minus 37,500. Similarly, 66,944 minus 37,500. The top row on the right hand side, that is a gross number, right? So you're just calculating incremental. That gross row is already taken into account the number of days. Look, you can look the bracket A into B upon 360. But what I'm trying to show you here is that if you calculate a quick percentage for me. So let's say in the policy A, what is my incremental profit, guys? 6550. And what is the incremental receivable? Is 14,722. Now, what would be that in terms of percentage? What would be that in terms of percentage, guys? 6550 divided by 14,722. So we're getting 44.49. Is everyone getting 44.49? So even if I talk about incremental return approach, expected return approach, I will select the plan with the highest return. Highest return. Because on the other hand, when I'm looking at the next policy, in the next policy, my expected profit or incremental profit is 9040 and the receivables increment is 29,444, which is I'm getting 30.7%. So I'm looking at 9040 divided by your incremental in kind of investment. So what are we talking about, guys, here? What incremental investment here? 29,444. So that's 30% for us. Neha says incremental approach doesn't differ much from total. So there is an advantage of Neha. It's like different way of looking at this. There is a different way of looking at this. That means in the gross approach, you are talking about total number at, I would say in terms of the evaluation of volumes. In the incremental approach, what we are doing instead is kind of getting this at a incremental level at each level so that probably our decision scenario could stop. Right now, in theory, we are actually evaluating 4 policies, right? Think about practical scenario. Let's say you are trying to increase the credit policy. You may be able to stop at a point that would definitely help you in a quick decision making. So it's good to know both the ways. Okay, Pooja has a question. Okay, Neha, I hope I was able to answer your point. Of course, decision will be same. I never said decision will be different. Decision will be absolutely same in the both scenarios. Otherwise, you are doing some kind of a mathematical calculation error. Now, in terms of, okay, another query I'm seeing is from Pooja. In total approach, B has a higher benefit than A, 140, 106. Very good. Pooja, good morning. Pooja, 140, 106 is A, not B. I think you got confused with the columns, right? First column is the present policy. Pooja, first column is not A. First column is present policy. Second column is policy proposed policy A, the first policy. Pooja, I think there is a clerical error. I think you are kind of confusing yourself by thinking that the first column is policy A. No. The policy A is actually the second column. First is the present scenario. What the business is doing presently. Okay, Hiral says, can we do this expected percentage method in incremental approach and not doing E and F point? I'm assuming, Hiral, what you are trying to say is that can we do a direct calculation? Then I'm absolutely okay with you. You are saying that can we directly apply that percentage in within the point C? That's okay. Hiral, I hope this is what you were asking. I'm looking at your question. I'm okay with that. It's not necessarily you have to drill down each and every step if you want to apply that, but you have to name that particular statement very, very carefully. Then you're not talking about incremental investments, then you're talking about return on the incremental investment. Straight away calculate the return and then calculate the incremental return. I'm okay with that. Hitesh, absolutely correct, Hitesh. I saw your reply. So guys, everyone okay here in terms of deciding which policy we are doing here? Everyone okay here? Let me know any further doubts, then we can proceed further. Okay, so now we move on to a very, very important aspect, guys. Okay. Last question from Smita. Will expected rate of return apply if we apply the total approach will be different? Okay, the point here is in the Smita, the point is in expected return approach, we are actually using a formula of incremental profit upon incremental receivable. Are you getting me? Incremental profit upon incremental receivable, because in the gross approach, again you have to first calculate that incremental profit. It could be one and the same thing, na? See, the point is incremental profit 1,44,000 to 1,50,000. Again, you get to 6,000, and then you have to calculate the incremental receivables. Probably that number is clearly directly not visible though here. Smita, I hope you got the point. You need to get the data in the total approach first. You could still get the same number. Okay, guys, now I would like to start or move on to a very, very important section, financing of receivables. I'm sure many of you, I'm not talking about the negative context, but many of you are aware, or probably if any of you actually forgot your bill payment or your mobile bill payment or something like that, are aware that there are collection agencies which call, right? For example, I am calling from so and so company, your bill is outstanding, kindly pay the same, and so on. So, okay, just give me 1 second, guys. I'm getting some comments from, okay, Smita says if we compare, and I got, no, Smita, again, the point is I told you, you have to calculate the receivables. You will again get to the same numbers because the formula will be same. So that you can check later on, not right now. Okay, so guys, I was talking about that many of you are aware that you guys get call from collection agencies or anyone who has kind of forgotten to make the payment. Think about corporate perspectives. Companies with so much of a long-term strategy, mission-driven organizations, will they really want to spend some time and efforts in running after customers for collection? Think about the companies who understand the aspect of working capital, operating cycle. Think about the students who are pretty much gaining some command over the last 3 lectures on this topic. Everyone understands the importance of operating cycle, right? I've got a very, very interesting example from Siddharth says that they gave the reminder of 3 days before the due date for recharge. Absolutely correct, Siddharth. And Banredi, your response tells me that electricity bill has been some troublesome for you. Probably when the parents would have asked you to submit the check and you would have forgotten, right? Don't worry. Did I actually say that? Forget it. Okay. So what I'm trying to say here, guys, is you all understand that importance of working capital cycle, and we all want to minimize the operating cycle, right? We want to shorten the operating cycle. Now, what will happen is, imagine that if you can opt for some process wherein you sell off your receivables to someone and get some money in and get rid of the collection headaches. Or if you are in the need of money, you go to a financial institution, you pledge your receivables with them. The bank or the financial institution will take the list of the account receivables. They will evaluate the quality of the receivables and they will give you the percentage of the loan against them. Let's say your receivables is 10 lakhs and they evaluate your quality of the receivables. They say that your receivables are of average quality. So for these 10 lakh of receivables, we will be able to give you 6 lakhs of loan. So now you got the 6 lakhs of loan. As and when the customers pay, the loan will be paid off. Or probably the understanding is that customers will not be knowing and actually will be transferring the money to the other redirected bank account. Okay, Bandreddy, I just saw that. I think you're saying it's other way around. Okay, glad I'm seeing that. Okay. Anyways, so guys, you have two choices here. That is for sure. What you want is that every business would like to have an early payment rather than waiting and sitting them at the end of the credit period, and in fact probably waiting for a bad debt, right? Every business wants to get an early payment, right? Because if you wait on for issued invoices, or you are kind of doing that regular aging analysis, you probably are moving towards a possibility of bad debt. But the point is, if you want to get the early payment, it's not a charity, right? Everything comes at a cost. Everything comes at a cost. Now, the first way, which I was explaining you just now, is pledging. Pledging means you are taking the list of your receivables to the financial institutions, keeping them as collateral or pledging them against any kind of a loan facility, where the bankings will evaluate the quality of those receivables and grant financial assistance. The funding could be anywhere between 50 to 90% of the receivables. That depends on the quality of the receivables. Not only that, it comes with a high cost of financing. That means interest rate could be high. But I have a problem here. The problem here is, if I'm looking at my balance sheet, my AR stays here as is. I get a loan from bank. My bank proceeds are high. There could be some equity which doesn't have any impact. But the problem I can see is my debt. My long-term debt increases. Do you guys agree that in this case, my debt to equity ratio is kind of deteriorating? My debt to equity ratio is kind of getting disturbed here because I am welcoming a loan in my balance sheet. Are you guys understanding? Are you guys with me on this? This is a problem with the pledging probably. Although you may get the funds, but there are two problems. A, will not be getting 100% funding. You may get 70% funding, 80% funding. B, it will be with a higher interest rate. And C, your balance sheet gets destroyed. Definitely not looking clean as before. You're adding loan to your balance sheet, guys. Just think of it. Another preferred way of financing of receivables, it is called as your factoring ways. Factoring entails absolute sale of receivables to a third party called as factor, who are experts of collections. Their business is collecting receivables. You're talking about sale of receivables to a factor here. Now, in this also there could be of two arrangements, whether you can sell outrightly without any risk of yours, which is generally called as without recourse, because that agent cannot come back to you now. And the factoring can also be there with recourse, where if any of your debtors don't pay the factor, because factor will be collecting those receivables, factor can come back to you crying, these are not going to pay us, please help. This is with recourse. Guys, do you agree with me? Or let me put it another way. Let me ask this question to you guys. If I am opting for factoring, I have two choices. without recourse and with recourse. Without recourse, the entire risk is transferred to the factor. Factor is assuming all the risk. With recourse, factor can come back to me. Which of the options of factoring could be more costly? Who will tell the answer? Which of the factoring option could be more costly? So that says without recourse is more costly. Everyone okay with that? Without recourse, my factor is taking some Shakti without, right? Not with. Because factor is assuming all the risk. Na? He will charge higher interest. He will charge higher commission. More risk, right? More risk, more return. Factor is taking more risk, right? So what factor will do, guys, in either without recourse and with recourse, they will charge the commission and interest. Commission for their services, interest for advancing the money in advance, and they can also withhold some amount for adjustment. So probably what will happen is, so those of you said without were absolutely correct. Some of you said with, you need to think. Hitesh, with recourse cannot help. With recourse, the risk is less, na? So they will charge less commission. Now, whether with recourse or without recourse, factor can retain some amount of money. That is not interest. That is not commission. That is just some retention. Why is that important? Because there could be some sales return. There could be some credit notes for price adjustments. In nutshell, there could be a scenario. Some sales are not final. And if some sales are not final, we are talking about this in terms of that if there is an adjustment, factor should have something in their command to adjust the sale. But the beautiful part against this kind of an arrangement is, if I look at the balance sheet, I had AR, which is gone. Debt is definitely not there. Bilkul nahi. Absolutely not, because you are not taking any loan here. AR is gone. Only thing probably is you might have in your balance sheet is due from factor on the account of that small retention amount. Some amount which factor would have withheld. Due from factor. It's like, for example, if your receivables are 10 lakhs, probably you will have 50,000 due from factor. That's it. Factor would just retain 5% and give you the 9,50,000 after deducting their commission and interest. Everyone okay, guys? I hope the concept of factoring with recourse and without recourse is very much clear to all of you. And one more important and interesting point, guys, is in what happens in with recourse is when the factor is not able to collect the money from one of the customers, they can come back to you, but they cannot return the customers to you. They can request you to replace those customers replace those debtors with a good debtors. So they will give those debtors back to you, and they will ask you, okay, give me some fresh debtors. These guys are not agreed. You can collect yourself. It's about a replacement here. So that says last point, please repeat. So that last point, I think you are asking about the benefit of the balance sheet perspective. In factoring, there is no loan. Account receivable you have outrightly sold, so no longer there. The maximum receivable could be some amount which is withheld by the factor. Guys, I hope this is clear to everyone. So this is a good understanding, guys. You need to get that clarity here. Now the point is, how do we decide? Again, we are talking about evaluation strategy. How do we decide whether we should go ahead with a factoring proposal or not? There could be more than one factor in the market. So you will have to compare the cost versus benefit eventually, right? For everything, we generally compare the cost versus benefit. So here we are talking about annual savings benefit on taking the factoring services. You may be having some cost of administration saved. probably you might have one person who would be regularly calling the customer. This is a small old mobile with some antenna. I don't know if you guys remember those mobiles or not, or a cordless phone. So this guy is under a lot of pressure calling the customers. You don't need this guy anymore, right? You don't need this guy anymore. Okay, I have questions from Shakti. Can you please explain with and without recourse again? Shakti, without recourse means that factor doesn't have any option to get back to you. He says that leave it to me. I will collect. It is all mine. All risk is mine. And with recourse, factor can come back to you and ask for different debtors. So all the risk is not assumed by the factor in the case of with recourse. Siddharth, absolutely amazing. Siddharth says factoring seems to be a off-balance sheet financing. I would still say, Siddharth, I think you agree with me, rather Siddhant. Siddhant said that. Factoring is an off-balance sheet financing. So Siddhant, this is a good way to look at it, that yes, there is a financing off-balance sheet, but probably as part of the disclosure, you might have to evaluate because you still might be showing some due from factor amount, right? Okay. Hiral has own evaluation, says that factoring is twice better than pledge. I tend to agree with you. But will it be twice or 1.5 times better? Who knows? That evaluation. That is entirely evaluation here. Okay, guys, coming back to this particular point. If you want to sell the data to the factor, you don't need that person in your office who was calling to the customers on mobile, right? Also, since these guys are expert, right? These guys are expert of their job. Am I correct? Or am I correct? What do you think, guys? These guys are expert of their jobs. So in that case, probably what we are looking at is that your bad debt should be definitely avoided. Smita is again asked, okay, guys, just give me a second. I think let me just clarify these points. Smita says, can you explain final impact between without recourse and with? Smita, what do you mean the final impact? There is no final impact. The key difference is in with recourse, your commission would be commission or interest will be slightly less because you're carrying an option, right? And in without recourse, of course, there will be higher commission and higher interest. Smita, you got it? So we're talking about a bad debts avoided. Then we are talking about interest saved due to reduction in average collection period. Of course, see, because you are selling to the factor, you are getting the money pretty early, right? So what you will be doing is like, if let's say your credit period was 30 days, but you are selling to the factors within 5 days. Of course, you're basically talking about reduction in the collection period by 25 days here. So that amount which you receive today in advance can be invested somewhere, guys. Kind of an opportunity cost here. So this is annual savings on taking factoring service. But please tell me, does these things come at a free of cost or everything comes at a cost, right? Pooja says factoring is as bills for collection gone by bank. It gets some commission. You could say that, Pooja, but there, yes, you are always contingently liable, and here you are talking about with or without recourse. You could say that's for comparison purposes, but yeah, in terms of banks, there are different financial instruments. You're talking about bills of exchange versus financial instrument. Here I am talking about your company versus the specialists who operate as factors. Okay. So guys, this again, but when we are evaluating the factoring proposal, everyone agreed to me that yes, since factoring comes at a cost and there are benefits along with that, you have to compare the cost versus benefit. We talk about 3 benefits till now. We are talking about the cost of administration saved, bad debts avoided, and probably the amount you receive early, you could be investing somewhere or opportunity cost. But what are the cost of factoring to the firm? That is very important here. We're talking about cost of factoring to the firm. Now, cost of factoring to the firm is majorly We are talking about the calculation of the commission and the interest itself. For example, we're talking about annual credit sales into commission. That's the calculation. Now, generally, uh, let me ask you a question. Commission is charged for the services provided by the factors. That's okay. They will charge on the percentage of sales. But as I said, do you agree that interest should be charged only on the amount which is given by the factors to you rather than the entire sales? Because they will be charging some commission. Also, they will be withholding some amount for some adjustments called as factoring reserve due from factor. Interest should be only on the amount actually received by you, right? So that is why interest is calculated on credit sales minus factoring commission and minus the reserve which you want to withhold. So that balance amount which is received by the company, on that you will be calculating the interest cost. So factoring is charging basically two things: factoring commission and interest. Factoring commission and interest. So that means A versus B, which will be giving you the net annual benefit or cost. You could take the decision even basis on the point number C, but the only thing is probably you would want to compare or calculate what is the effective cost of factoring to the firm. That's it. So basically the idea is that what is the effective cost of factoring to the firm? And then you will compare that. You will compare that with borrowing interest rate. If the interest borrowing rates are higher than the effective cost of factoring to the firm, then definitely you could go for factoring. That's your decision point. Because if you need funds, you will either go for a loan or you sell off your receivables to the factory. So you will compare the interest rates. But having said that, depends on the information given in the question. You could take some decision even at the point number C if they are asking you whether the benefits are more or cost is more. Because point number A talks about the benefits, point number B talks about the cost. I hope this entire discussion makes you comfortable, but I think a lot of us don't feel comfortable unless and until we see some numbers in the form of words. What they say beautifully is that when you add the numbers to the words, the feelings are different, understandings are different. So let's give the terminology some numbers here. So the company, Heaven's Company, has credit sales of rupees 240 lakhs with an average collection period of 30 days. Financial controller here estimates that the bad debt losses around 1.5% of credit sales. Wow. Hey, look at this. Firm spends 1,40,000 annually on debtors administration. The cost comprises of telephonic and fax bills with salaries of the staff members. That's too much, right? These are the avoidable costs. That's good, they told us. A factoring firm has offered to buy the firm's receivables. Factor will charge 1% commission. As I said, commission will be on the sales and will pay an advance against receivables on interest at the rate 10% after withholding 10% as reserve. Are you guys getting the context here? So the entire information in terms of the required information is given to us. Smita says, can you please explain point of cost of factoring with interest rate? Smita, can we just go through that with the example here? I think that will be better. Because we will calculate what amount the factor is lending to the company. Interest will be charged on that and not on the entire sales. So I will answer your query while we are walking through this illustration together. You guys need to tell me certain important aspects here. Please tell me, guys, if you are going for factoring, what is the savings for the company? Can you please tell me quickly? What are your savings here? What are your savings? Just tell me that part. I can see 1,40,000 of the administration benefit is given. So I think if I talk about from a savings perspective, 1,40,000 of the debtors administration cost, which is avoidable. And then they're talking about the bad debts, right? So what is 240 lakhs into 1.5%? 240 lakhs into 1 lakh or 240 lakhs into 1.5%. I think that comes out to be 3,60,000. So do you agree that probably total saving out of this plan is 5 lakhs, guys? Yes or no? Yes, Sudhanshu, Siddhant, Hiral. Absolutely correct. Siddharth, I think one more zero. So 5 lakhs is what I'm trying to say. But there is a cost attached also, right? Can you guys tell me what is the commission here? Factors commission? Factors commission seems to be 2.4 lakhs if you're talking about 1%, but that is annual number, right? 2.4 lakhs, that's what you're trying to say. Smita says, I did not get. Okay. Guys, please try to understand. Everyone okay till 5 lakhs? Smita, you did not understand the 5 lakhs? The only two areas which you are able to save is the cost of savings and the bad debt. So cost of administration is 1,40,000 and 3,60,000 is your bad debts is 5 lakhs. Smita, that is clear, right? That is given to us. In the second line, firm is spending 1,40,000 on the debtors administration, and then we're talking about the bad debts, 240 lakhs into 1.5%. So total savings is 5 lakh if you are selling these receivables to the factors. That's what we are talking about here. However, we need to understand what will be the cost. Someone says that the commission is 2,40,000. Really, guys? Are you selling your sales to the factors, or are you talking about your receivables to the factors? First of all, tell me that. This is the interesting part. Are you selling your sales to the factor or receivables? That is what I want to understand. I think you are selling the receivables, right? In that case, don't you agree? First, you have to calculate your receivables. What's your AR? 240 lakhs divided by 30 days. Or should we divide by 12? Can you please tell me? Should we divide by 30 days or should we divide by 12? I think 12, right? 30 days is 1 month. So let us take it in the month in the terms of number of months we are talking about. Am I correct? Everyone is like talking about selling the receivables. So 30 days is what we are talking about. Either divide by this by 12, or you could divide it by 360, multiply it by 30. You will get receivables of 20 lakhs. 20 lakhs of receivables we are talking about. So commission should be ideally in terms of the percentage 1% of 20 lakhs. So we're talking about 1% of 20 lakhs. So let us walk through this together. Your average monthly receivables are 20 lakhs. Everyone with me on this till this point? Factors commission is 1% of 20 lakhs, that is 20,000. And they have told you in the question that factor has withheld 10%. So 10% is 2 lakhs. Hence, the factors are only giving you 20 lakhs minus 20,000 minus 2 lakhs, that is 17 lakh 80,000. Smita, this is the point. This is the point I wanted to mention here. Siddharth says, sir, 3,600 will be the bad debts. Siddharth, how you are talking about bad debts here? $240 lakhs. Siddharth, it is 240 lakhs. Please check. Okay. Smita, are you with me on this? Everyone else? What is the fact? What is the amount the factor is giving? 20 lakhs minus commission minus retention. So 20 lakhs minus 2 lakh 20. Is everyone okay here? 17 lakh 80,000 is what factor will be giving. So interest will be charged on that. And that is interest is 10% per annum. For 30 days, the interest will be 14,833. Yes, interest calculation is clear to all of you, please. Now you need to tell me, guys. We had calculation of the 5 lakhs on an annual basis. And right now the factors are talking about 20,000 commission and 14,833. 34,833. Can anyone tell me? So this 34,833 is more of a benefit per month. If I want to multiply this by 12, how much do I get it? 34,833 multiplied by 12, guys, on a monthly basis. Who will be able to tell me this? Am I getting 4,18,000? On a round figure, am I getting 4,18,000? Roughly 4,18,000. That means we are talking about saving of 5 lakh with a cost of 4,18,000. So net benefit is 82, guys. Net benefit is 82. Everyone with me on this? Everyone with me on this? Some of you were wondering that can't we directly do it on an annual basis? You could do that. So like we were talking about, every month receivables will be the entire credit sales. You could calculate that as entirely a 1% commission of 240 lakhs is 2,40,000, and then 1,78,000 will be your interest. It will directly give you 4,18,000. Karthik, since we are discussing, as I saw your comment, I would rather request you to email your queries because we are on to some important aspects of working capital management. So I'm sure if those relates to the topics already covered, it would be better if you would email that to us. And if your doubt relates to the today's session, which we have already covered since you joined late, probably I recommend you to watch the recording again, maybe. That will help you. So guys, what I was explaining you, you could actually do a kind of annual computation also. The only thing is that you just need to understand that you're actually selling of the entire credit sales or on an annual basis. So if I talk about only on an annual basis, like we were calculating earlier, 240 lakhs into 1% is my commission on the factor, and 17 lakh 80,000 into 10%. That means we're talking about 1,78,000. What I'm writing on the top. So total also you could have got 418 straight away. So what you compare the 5 lakhs with 4 lakh 18,000, we are getting a net benefit of 82,000 here, guys. Guys, this is making sense to everyone? Does this make sense to everyone here? Here, that's absolutely fine. That's what I'm saying. It's just that you can explain your working, that's absolutely okay. Everyone, guys, all okay here? Okay, so what I want to do right now, it's 7:25. Let's do one thing. Let's take a quick break, guys. Karthik, I will provide you the email ID after this. Okay, so I would like everyone to just refreshen up yourselves. Let's take a 10 minutes break. Once we come back, we have just few concepts to discuss in terms of the payables or the inventory management. I don't want to take some time on this. We will be rather going to some kind of a practice questions around after 15 to 20 minutes of discussion, which is still pending. So let's take a quick 10 minutes break, guys. And then towards the last half an hour, we'll be attempting at least a couple of practice questions. See you on the other side of the break. Welcome back, everyone, after a good deserved break. So, we resume our discussion. And before we do that, a quick query from Raghavan, why we are paying interest to factor, why we're already paying them commission. Okay, very, very good question, Raghavan. I think, anyone else wonder that, by the way? Or while looking into or hearing to his query, I'm sure some of you must be wondering, it's a good question, right? Why we are paying interest and commission both? So, Raghavan, you are getting rid of the headache of the collection. The factors are providing some services. Am I correct? You pay them commission. Pay them commission for that service. They are collecting your receivables. It was your job, not theirs. So you pay them commission. But Raghavan, that money you were getting after 30 days, they're lending it to you today. For advancing that money much ahead of time, you're paying them interest also. Is it now set? So commission for the services, interest for advanced lending of the money. Okay. I think there was a question from Karthik. So Karthik, if you have any questions for the previous session or anything, you missed out during the session or even after the lectures, you can post that to fm-inter@ici.in. I think everyone knows that email ID. So, okay. So guys, continuing our session with the few more things I would like to talk about. One is forfeiting. Now, forfeiting as a term refers to relinquishing a right here. What do you mean by relinquishing a right? Basically, this concept came into with respect of facilitation of international trade. What happens is, if you're talking about importing versus exporting, think from an exporter perspective. If exporter is sending the goods to international domain, what is the main concern exporter will have? The payment, right? What is the surety? They don't know the person who is Sat Samundar Par. You don't know, right? So, for the facilitation of the same, international, at an international level, we're talking about services like line of credit, where importer approaches a bank, draws a letter of credit to kind of give a surety that the bank will oblige that invoice. In that case, what will happen is the bank kind of buys the receivables or invoices from the exporter, who relinquishes his right to receive the payment from an importer there. So what will happen is the bank will actually pay the exporter, and hence you cannot take the payment from the importer now. So it's a kind of an overseas buyer arranging a letter of credit from his bank in the favor of the exporter, and that will be kind of acknowledged by the exporter's bank. I hope that you guys are understanding this. So we are talking about an arrangement for facilitating the international trade, where it is just that exporter who is relinquishing the right to receive the payment from importer. Yes, Hitesh, relinquishing the right, giving up the right. So basically, you cannot collect the payment from two sources, right? You wanted a guarantee, you're getting the payment from the bank directly. That's it. Now, I think some of this we have already talked about in the last lecture. We talked about the latest development in terms of like when we talk about the cash management also. Same thing for receivables, guys. I'm sure a lot of you agree that yes, Siddharth. So that's absolutely correct. So we're talking about the letter of credit. Okay, so I was talking about the latest developments, guys. So with humongous transactions, cross border, huge transactions in terms of receivables, high volumes, There are aspects, there are techniques which we discussed earlier also, like lockbox, concentration banking, direct deposits. We're talking about the latest technology with ERP systems. Let's say a customer is having a credit limit of 500 or a rupees 5 lakhs. Let's say there is an overdue amount of 4 lakh 50,000 and the next invoice is 1 lakh. Probably you have only two choices. So either the system will reject that invoice to initiate that invoice. Reason is that the customer is already owing you 4 lakh 50,000. So either you increase the credit limit of that customer or you block the transaction and you give the notification to the customer that, hey, you guys need to clear your pending invoices for further sales. So that's the use of the latest technology here. Not only that, with respect to the various financial tools in terms of what we have discussed also, like we're talking about the aging analysis internally or taking the help of external agencies with respect to the credit rating. It also helps us to do the business with respect to better rated customers. Hitesh is asking, sir, Logbox is like a broker. No, Logbox, Hitesh, we discussed when we were talking about the advancements in the cash management, where it's like a post box kind of a service where you the provided by the seller's bank at various locations, where you kind of give the addresses to the customers to deposit the checks in those lock boxes, and the banks actually collect those checks on the customer's behalf and send it for clearing. So it basically eliminates or reduces your mailing float. Okay, efficiency in internal business practices, of course, early issue of invoice with the ERP systems, continuous monitoring. If required, we are talking about updating of credit terms as all. Because see, the point I think we discussed in the last class also, when a customer is new, what's happening is initially you may not want to advance a huge credit period. Today also someone said that to some customers we can give bigger credit period, to some customers we may not give. So as the customers become older, more reliable, you may want to give additional credit period. That can be done. So again, this is the role of latest developments, monitoring. We talk about online transfer of funds with a lot of integrated modules across the business that helps your the monitoring aspect of the receivables management. Now, there is a very, very interesting example here where we talk about the Abhipra Limited having a current sales of 18 lakhs per year, 75% of sales, and bad debts, cost of sales is 75%, and the bad debts are 1%. And the cost of sales is 80% variable here. 80% variable means, are we talking about 60% of sales probably? And 20% of the fixed cost are there. That means 15%. Well, the company's required rate is 14%. So company is currently allowing the customers 30 days credit period, but is considering the increasing to 60 days to increase the sales here. So we're talking about increasing the credit period to 60 days in this regard. It has been estimated that, yes, Mita, absolutely correct. So it has been estimated the change in policy will increase the sales by 15%. While bad debts will also increase. We discussed this. If you're talking about 30 to 60 days, your bad debt, look at the bad debt, 1% to see the 4%. It is not expected that the policy will change any increase in the or any change any fixed cost, and even creditors are unchanged. So should the company introduce the new proposed policy? So what we are here analyzing here is, what is the new level of sales, guys? What is the new level of sales? 18 lakhs plus 15%. So we're talking about 20 lakhs 70,000. Am I correct? $20 lakh 70,000. Everyone with me on this? Everyone okay? What will be the variable cost, guys? Variable cost, as I said, 60% of the sales. So 60% of the sales is like 20 lakh 70,000. You could easily kind of compute that part. What we need to understand is that the variable cost here is 60% of the sales, whereas The fixed cost is 15% of the sales. But guys, please ensure that the variable cost, when we talk about 60% of the sales, we can do it of 20 lakh 70,000. Well, this is a variable cost. Variable cost will change. But when it comes to the fixed cost, this has to be 15% of the existing level of sales. That is very important. See, what we are discussing right now, should we change the policy or not? So what we are talking about basically is the comparison of the existing policy in terms of what will be happening if we kind of go to the new policy. So what is the proposed investment, guys? What is the proposed investment here in terms of the receivables? We're talking about the total cost. So 60% of 20 lakh 70,000 plus we are talking about fixed cost 15% of 18 lakhs here. Everyone with me? I'm just looking at the query panel. Everyone is looking me at answer of 12 lakh 42,000. Everyone getting that? 12 lakh 42,000. But I hope you guys are not missing that factor that we are talking about for the credit of 60 days. Whatever you are getting, guys, kindly multiply that by 60 upon 360 here. What I'm trying to say here is this. We're talking about the proposed investment in debtors is variable cost plus fixed cost. So 20 lakhs into 70,000 into 60% plus 18 lakh into 50. So Smita says 15 lakh 12,000. Smita, but I think you need to do multiply that by 60 by 360, right? That's what we're talking about. That's the investment for 60 days, right? Smita, does it make sense? So you'll get 2 lakh 52,000 basically. So 2,52,000, everyone is okay till this point? And what is the current investment in the debtors? Is 18 lakh into 75% straight away you could have done. So we're talking about like 1,12,500. So that means increased investment is 1,39,000 guys. So what we have got is the change in the impact of the policy just by increase in the investment in debtors. That is 1,39,500 now. And then we are also calculating the benefit in terms of the contribution. Now, what is happening here is we are looking at 80 lakh into 15% into 40%. Can anyone tell me why we are doing this? Do you agree that cost of sales was 75% of the sales, wherein the variable cost is 80%? So can we say 60% of the sales? So basically, if 100 is my sale, my contribution is 60 here. Or vice versa. If 100 is my sale and variable cost is 60, my contribution becomes 40 actually. So can we say directly 40%? Can we say that? Let me just write it again. We are talking about a sale of 100 with a variable cost of 60. That means what we are looking at is at a contribution of 40 in this case. And that is why we are multiplying this by 40%. And why 15%? Because that is the increase in sales. 18 lakhs into 15%, that's the increase. 2,70,000 into 40% is 1,08,000. But the interesting point is, we are also talking about increase in bad debts humongous. My original bad debts was hardly 18 lakhs into 1%, and 20 lakh 70,000 into 4% is the new one. That means there is an additional bad debt of 64,800. 64,800. So guys, my benefit out of this. So let me just put some kind of alphabets here. My benefit out of the change in the policy is increase in the contribution. That is 1,08,000. The costs are two, increase in bad debts and additional financing cost. So bad debt differential is 64,800 here. And since we calculated 1,39,500 additional investment, can we decide that we can invest it as an opportunity cost for 14% that was given to us? Guys, everyone okay with this? The company's required return is 14% here. And why we are not again multiplying that with number of days? Because that is anyways considered in the calculation of increase in investment of debtors. So we are just doing directly 14% of 1,39,500. So the additional financing cost, or I would say the opportunity cost, is 19,530. So that means my total cost is actually kind of 84,000, and my increase in contribution is 1,08,000. So the better is changing the policy, because I'm getting my increase in contribution, which is basically larger than the cost incurred by approximately 24,000. That means you should advise the company to introduce the new policy. Everyone with me on this? I hope everyone is okay till now. We have already done 2 credit policy decisions. We have already done 2 examples today with respect to the credit policy. Now, what we'll be doing is, after this, we'll be just quickly talking about a couple of aspects with respect to management of payables and inventory. And then I will be liking to attack 1 or 2 questions with you guys. And there are some assignment questions in the file. I think last class, there were people who were asking me about the assignment question. This particular file, which I had already uploaded, have some practice questions at the end. And I will be also uploading the solution file as well, right? Smita says it is a little confusing. Smita, just make it simple. Make a note of benefit out at one point. What is the benefit? Increase in contribution. Fixed cost, there is no change. And there are 2 costs associated: increase in bad debts and opportunity cost. That's it. Think it that way. You can change the sequence. I think one student told me that why can't we just calculate the benefit together at one place and then work on the cost? We can do that. If you're getting confused because we just initially calculated the increase in investment and then came back to the opportunity cost, that's fine. You can change the sequence. That's absolutely fine. So I think some of you want that, right? You want to calculate the contribution increase on the top and then do entire calculation. That's absolutely fine, guys. Smita, is it okay? I think that way it will be less confusing. Great. Now, guys, one thing when we talk about management of payables, we discussed this in operating cycle, that the time the vendors provide a very, very important source of short-term finance. Now, although we want to take the maximum advantage of the credit period, we cannot slow down the payments beyond the credit period, because otherwise we'll lose our reputation and probably we will not be able to get the raw materials or get the purchases done on our favorable terms. Now, that means it's very important that we need to understand that if we are availing the credit period and let's say we are missing the deadline, we are losing the reputation. Or other way around, you remember my credit terms, 2/10 net 30. That means a credit period of 30 days, 2% discount if paid within 10 days. So if I'm missing the 30 days, I'm losing the reputation. If I'm missing the 10 days, I'm losing the discount. Now, what is the deciding factor? So I am concerning myself that there is an option that I can pay within 10 days and get 2% off. But that means that probably I have to arrange for money 20 days in advance. Or probably you can decide that maybe 11 to 30 days, you can have your money invested somewhere else and then pay on the last day. Because I think everyone is agreeing with me that whether you take the discount, you will pay on the 10th day. If you don't take the discount, you pay on the 30th day. Hiral says, why fixed costs are not changed in the previous question? Hiral, why the fixed cost will change unless they tell you anything on the capacity front? Why would you change the fixed cost? Fixed cost is the so guys. Hiral, you missed out the question. That means question clearly mentioned the policy change will result. It is not expected that the policy change will result in increase in fixed costs. It was mentioned in the question, Hiral. Please read the question. I'm sure your doubts will be clear. Okay. So guys, everyone okay with the two options? Either I pay less than 10 days, get 2% discount, but I have to arrange funds 20 days in advance, or we pay on the 30th day and keep the money invested somewhere else. That means at the end of the day, what we need to do is we need to know what is the investment or the opportunity cost outside in terms of the interest rate, what we can get by investing money outside, and what is the cost of foregoing discount. Now, this formula you need to know, guys. 360 upon credit period minus discount period, and we're talking about discount upon 100 minus discount. What we're talking about here is, let's say, in this example, 2 by 10 net 30. So we're talking about 360 upon 30 minus 10. Because 30 is my credit period, discount period is 10, multiplied by 2 upon 98. So I think probably this might give you 36.17 or something like that. What you can check your calculations. So it gives you 36 to 37%. It gives you 36 to 37%. Smita says, comparing the opportunity cost and making on last day or within 10 days. Yes, Smita. So basically now, if you see the annual cost of foregoing is 36.17%, I'm already getting very excited. Do you get these returns in the market? I don't think so. You may not get 36% outside, right? Probably get the discount here. But if this number was, let's say this number was 9%. Let's say this number was 9% and you are getting somewhere return of 12 to 13%. Then you can forego the discount. Then you can forego the discount. But I think 2% discount when by paying 20 days earlier is a huge. I think why can't you do with a very, very blind level calculation, a 2% discount for a 20-day early payment. So if a 360 days is a year, so 360 divided by 20 is 18, and you're talking about 2% for every 18 days. That means yearly it's an impact of 36 plus percentage. So basically, I think in this case, probably the discount is definitely much more preferred. So guys, please remember this formula, annual cost of foregoing the discount. This is important. You guys can get as part of a smaller question. Don't lose that opportunity. 360 upon credit period minus discount period into discount upon 100 minus discount. So this gives you an idea of comparing whether we should avail the cash discount or not. Now, last part I would like to quickly talk about, guys. I don't want to spend much time on this. I'm sure many of you have done inventory management as part of the costing anyways. I hope you understand. We discuss in the working capital management also. We talk about in the investment decisions also that if you're talking about high level of inventory, we can have more sales, but the problem is carrying cost and the opportunity cost. The stocks can be perishable, storage cost, and so on. With low levels of inventory, your carrying cost can be less, but ordering cost be more, and there could be a loss of a risk of stock out. I'm sure no one would like to go to a shop again and again if the stocks generally is not there, right? So the idea is, should we keep more stock or less stock? There are techniques which generally help us. Techniques like economic order quantity. That is the quantity which you should order, which keeps your carrying cost and ordering cost in balance in minimum. Or you can use advanced technologies like just-in-time inventory, which kind of make sure that you brings in process efficiencies. I hope everyone is okay in this case. So I've given a quick illustration here. We're talking about the company distributor of air filters to retail stores. It buys its filters from several manufacturers here. Filters are ordered in the lot sizes of 1,000 and each order costs 40 to place. So demand from the retail stores is 20,000 filters per month. Carrying cost is given as 0.10 filter a month. Compute the optimal order quantity so as to many lot sizes. Hiral is asking me a question second time. Will aging schedule sums can come in the exam? Hiral, you're talking about aging schedule with respect to the credit policy, or you're talking about from the perspective of the bad debts? If you're talking about from a credit policy, definitely yes. Bad debts you can actually evaluate based on the information given. Okay, Hiral. Okay, so now I want to talk about this. Can you please confirm if you guys are all aware of this formula, EOQ? 2 into annual demand into cost per order upon annual holding cost per unit. If that is the case, can you please give me the answer for EOQ here? For option number A only. Option number B and C can be homework for you guys. I want EOQ only for option number A. Waiting for your answers, guys. So what do you think? Okay, I'm getting only one answer till now. Only one answer till now. I think I'm getting answer as 4, I guess. Bandredi get 4,000, Siddharth get is 4. Hey, those of you are getting 4,000, remember that orders are in the lot sizes of 1,000, right? Orders are in the lot size of 1,000. I think some of you are getting 4,000. You guys can just divide that by 1,000. I think I am getting answer as 4, EOQ as 4 here. So option for B and C, you guys can do a homework as a homework later on. But definitely the answer is 4 because I can see some of you are giving me answer as 4,000. Remember our order is actually 20,000 filters per month. So if you're getting 4,000 and the lot size is of 1,000, so that means number of EOQ in terms of orders is 4 actually. Everyone okay, guys? Everyone fine? Great. So now let's do one thing. Let's talk about an important concept with respect to financing working capital as the last 2 minutes. Well, then we move on to some questions here. We discussed this in investment decisions that working capital could be when we talk about the financing decisions as well, the cost of capital and everything. That working capital can be for the permanent in nature or temporary in nature. Some working capital always stay invested in the business, but when we talk about some working capital could be could be required into off season and peak season. Now, what are the sources of working capital? We just now discussed, like time provided by the vendors, or we talk about the trade credits. We talk about the intercompany loans and deposits, probably the funds generated within the business, factoring of receivables. We discussed that. So all these are even the commercial papers in the market. I think what you studied in the first chapter are actually good sources of working capital. The only thing I would like to add about here is that there had been committees in the past which generally kind of provide some recommendation in the sense that some part of the working capital, because the working capital is also entailing the permanent working capital, should be coming in from long-term funds. What I mean to say is, when we are talking about maximum permissible bank financing, funding from the financial institutions in terms of the working capital, the suggestion coming from the Tandon committee was 25% of either working capital or current assets should be funded by the long-term funds. Why so? Because there has to be some part of the permanent working capital coming in, staying invested in the business for the solvency of the business. This is very important, guys. So make sure that you guys are aware of this concept. Now, time for some MCQs, guys. While you answer this, please mention question number with the answers. Couple of questions. Okay, I'm already getting in some answers here. What are your guesses in this one? The maximum answers coming in for question number 1 is as B. We are talking about the technique where we are discussing on the firm for the customer's instructions to mail their payments to a designated post office collection centers. I think someone asked that question today itself. So you guys are absolutely spot on that. That is definitely logbox. What about question number 2, guys? I think these are two easy questions just to kind of give you a good breaker or a breather, I would say, before we go on to attack some working capital questions. Okay, for question number 2, I can clearly see that some people are answering me option number A, some people are answering me C. If those of you are answering, kindly ensure that you guys actually read this word, gross. And I explained when we started this working capital management discussion on Thursday last week. Those of you are telling about C, guys, that's a working capital or net working capital. But when they specifically talk about gross, it has to be investment in current assets. So folks who said A are absolutely correct. It's gross working capital, guys. It's always the current assets. Okay, so now we move on to kind of look at some kind of a practice scenario, and I want everyone to be with me. So we're talking about the working capital, what we started of the working capital management. I would like to definitely look at 1 or 2 questions here, and then there are a couple of questions for you guys to do a lot of practice at your end. This company is a newly commencing business since 2019. That could be an important term here, right? Newly commencing. So there could be some information with respect to the beginning, which you may not need, right? So projected P&L account is given to us, sales, COGS, gross profit. And then they're talking about the provision for tax, profit after tax, and they're also talking about how does the cost of goods sold has been arrived here. Material used, wages, depreciation, and there is a stock of finished goods that is 10% of the goods produced which is not yet sold. The cost of goods sold relate to the finished goods and not to the work in progress. Goods equal to the 15% of the current year's production will be in process on the average requiring full materials, but only 40% of the other expenses. I'm sure some of you are feeling disheartened by reading all this because probably you are already feeling that there is a work in progress calculation. I'm sure some of the students right now are having some scare in terms of the work in progress. And I'm sure more and more you practice, you can get rid of that fear. Company believes in keeping the materials equal to 2 months consumption. So they have information with respect to raw material. We have information with respect to WIP, and we have information with respect to the finished goods. All expenses will be paid in 1 month in advance. Very good. So we're talking about in advance this time. Suppliers are giving 1.5 months credit. Sales will be 20% of cash. Rest 2 months will be credit. Rest at 2 months credit rather. And 70% of the tax will be paid in advance in quarterly installments. Wow. Company wishes to keep each thousand in cash and 10% has to be added as a margin of safety. So we have to calculate the working capital. Now, while we solve this, can we talk about firstly as an inventory? To start with, can we talk about inventory, guys? That's a major part. Then we can talk about debtors also. So what do you think, guys? In terms of inventory, what is the type of raw material we are looking at? 2 months, right? 2 months consumption in the stock. How do you calculate that? How can we calculate that part? Let me see who answers this. Raw material inventory, guys. 2 months, right? So can you even tell me what will be the total consumption here? Total consumption. They have given the cost of goods sold has been with respect to the 84,000 here. But are we talking about in terms of only the cost of goods sold? The call here is the company believes in keeping the materials equal to the 2 months consumption in the stock. Don't you agree? In that case, probably the WIP is also included. Smita, Sudhanshu, you guys are talking about 14,000, right? Somehow I'm not very much comfortable with 14,000. Because what you have done, guys, is 84,000, right? But for raw material, please try to understand. 84,000 is only the cost of goods sold. But consumption method WIP is also there, right? So WIP raw material, because you can see the second line, goods equal to 15% of the year's production will be also on process on average requiring full materials. So please add 15% here, which is 12,600. So your full consumption is 96,600, guys. Consumption is 96,600. Smita, Sudhanshu, are you guys getting it? Then you multiply it by 2 by 12. Then you multiply it by 2 by 12, guys. So probably you should be getting 16,100 as far as the raw material is concerned. Guys, everyone okay? Everyone with me on this? Just want a quick comfort level for everyone. Because we are talking about 2 by 12. That will be like 16,100, I guess. Then we also attack quickly on the WIP front. Now, WIP, what do we need? Raw material we just calculated. We're talking about 12,600. Am I correct? 15% of the production, we need that. Everyone okay here? We need 12,600. But what about the labor and overhead? Labor and overhead, they're talking about only 40%. So the labor and overhead, Smita says, how do we get 12,600? Smita, 84,000 into 15% is how much? Can you check? This 84,000 into 15%, please check. It seems it's kind of a 12,600 to me. Let me know if I can. You want me to correct it? Achha, so labor and overhead here is 62,500, but we are talking about only 40%. Only 40%, guys. They mentioned that, right? In terms of labor and overhead, We're talking about only 40%. That too, WIP is only 15%. Don't get confused here. WIP is 15% of the production, or let me put it that way. Let me put it that way. In terms of labor and overhead, we are talking about 60 to 500 into 15% is what we are talking about WIP, but that has to be multiplied by 40%. Can anyone tell me what is that number coming out? Labor and overhead, 60 to 500 into 15% is WIP, but they're telling me that only 40% work has been done. Okay, someone says 3750. Someone said 3750. So guys, do you agree then the total WIP becomes 350 here and 16 350 guys? Total WIP becomes 16 350. That means, is everyone with me on this? All okay here? Are you comfortable in the finished goods of 17,000? I am not comfortable. I am not comfortable, guys. I don't know why. The only inventory aspect which is left here to discuss is the debtor, is the finished goods. Now, in the finished goods, they are calculating 17,000. The problem is this 1,70,000 also includes the depreciation, which should not be there. So ideally, finished goods will be 1,46,500 into 10%. 14,650. Depreciation should not be included. That's what I told you, right, last week. Can we quickly validate our answers? Whatever we have done. We are talking about the inventory, 16,100. We are talking about the WIP. We calculated this. 16,350. We just did the finished goods 14,650. I want everyone to be comfortable till this point. We needed to eliminate the depreciation, guys. All okay, guys? Now we move on to the debtors. Now, debtors is a very, very interesting aspect here. We know that in terms of the calculation aspect, they're talking about a credit period, right? And what is a credit period? We're talking about 20% for cash and rest are 2 months of credit. So we're talking about 80%. Now, for the debtors, we need cost of sales. But cost of sales would also include other expenses. And that's what we are doing here. So we are talking about cash cost of sales. Material 96,600. Please don't ask me how, because we calculated this 84,000 plus WIP. So material is 96,600. Labor and overhead similarly 66,250. How 66,250, guys? 62,500 plus 3,750. And we add admin and S&D as well, the selling and distribution as well. And then we reduce the closing stock. Because we are talking about cash cost of sales. Someone may argue with me, say that we are first adding the WIP and then we are reducing the WIP. It's up to you. Conceptually, you should go with cash cost of sales. Cash cost of sales is cash cost of production minus ending inventory. Cash cost of production minus ending inventory. And closing stock, we're talking about in terms of WIP and finished goods. So we are talking about 80% of the credit sales for 2 months. That gives us 21,180 here. I want everyone to be comfortable on debtors as well. We are including the entire cost, cash cost of production, and we are reducing the closing stock. And hence, we are arriving at, in this case, in terms of 158,850. We're talking about 158,850. Guys, all okay? Raw material, of course, we are not adding it because that is not included in the material, so it's even out. Guys, can you please check if the debtors are comfortable for everyone? 21,180 here. Let me check if there are any queries. Great. Now, we were talking about some expenses paid in advance. 1 month, all expenses are paid 1 month in advance. So what are the expenses, guys? 1 month in advance. We are talking about labor and overhead, 66,250. We just calculated that. Admin and selling and distribution, 27,000. So everything divided by 12. That is talking about 5521, 2250, and the taxes are paid quarterly in advance. So 1750. Labor and overhead. Why we are talking about 5521? Why we are talking about 66,250? Because that's a total expense. Mind you, total production, we're talking about total expense. 66,250 is my total expense. That into 1 by 12. These expenses are paid 1 month in advance. So this is prepaid expense for us. So 1 by 12 for labor and overhead. Selling and distribution was 27,000, 14 and 13. Again, 1 month in advance, so 2250. Taxes, which was given in the question, that will be paid quarterly in advance. So we're talking about 7,000 divided by 4 is 1750. So that's what we are talking about here is 9521. That means including the cash, which was given again, our gross working capital becomes 85,801. Can I get a quick confirmation, guys, from everyone that you guys are comfortable with the gross working capital? 85,801. Can I get a confirmation, guys, from everyone? Again, those of you are feeling that, okay, probably you want to practice. Yes, you want to practice. There is no doubt in that. Working capital questions you need to practice, only then you can gain command. And I'm sure by now you realize that practice those questions with WIP to get more confidence. Okay, now we are talking about the next section, that is creditors, guys. And when you talk about creditors, they're talking about 1.5 months credit. Can anyone tell me what will be the total purchases, guys? We have already discussed the purchases here. Did we talk about the purchases already? Total purchases was raw material consumed per closing. Do you agree? Because opening stock is not there. Opening stock is not there. So raw material plus closing stock 96,600 and 16,100. That multiplied by 1.5 by 12. Is it okay, guys? Everyone okay with the creditors? 14,088. Siddharth says only inventory and debtors are the crux. I think Siddharth, I would add creditors also. You need to understand creditors also. You need to understand the creditors also, because we are talking about creditors. We are talking about total purchases. That's raw material consumed plus the closing stock. Not only that, there is a provision for tax you need to be careful about. Out of 10,000, there were 10,000 tax, right? We are talking about 10,000 tax. If you look at your income statement, 10,000 tax, we are talking about only 70% of the payment in advance, right? So that means 3,000 provision here, 3,000 of the tax payable. So 3,000 tax payable is added to give us a current liability of 17,088. That means the working capital is actually 68,713. You add 10% margin and you get 75,000 as a working capital. Smitha, you need to check something. I think I'm sure, I'm not sure. Okay, you're giving me an answer for purchases, right? That's okay. If that's the case, that's fine. 1,12,700, that's fine. But the working capital should be 75,580 or 584, whatever. Hitesh has already confirmed. What about others? Everyone else, guys, all okay with this question? Okay. So, guys, now I'm just kind of in the paucity of time. I would like to talk about few questions for you guys as a a bit of practice. We discussed a couple of questions today with respect to the credit policy evaluation. So there is a question which talks about of the slow payers that you guys can try later on. I'm not attempting it again. Then there is a working capital question on starting for day limited, and I will be uploading the solution part today, guys. Don't worry. Those of you don't have the solutions with you, so there are a lot of practice questions here. So and one question I'm giving you as an assignment with respect to the cash budget as well. So I'm sure we did a couple of cash budget exercises in the last class that will help you. But before we log off, I want to spend just around 6 to 8 minutes. I hope you can bear with me. One question I would like to talk about in the class. Other three will be your assignment, and I will be uploading the answer files as well. Okay. The another file will be uploaded, will be having the solution as well in that. How do you consider tax point? Smita, in the P&L, there was a provision for 10,000, right? Smita, in that question, in the P&L, there was a 10,000 provision, but you are paid only 7,000 tax, so the 3,000 is still payable. Smita, are you getting it? So, guys, I'm giving you three separate questions as an assignment. One is of cash budget, one is of credit policy, and one is of working capital. So, one each from three major sections. I hope you guys can do that practice. Can you guys please confirm? Three questions for you guys an assignment. So before we log off, let's attack one more question. This should not take more than 8 to 10 minutes at maximum. Because this is just three separate evaluations of the credit policy. It is a very interesting question. So Alliance Limited, a petrochemical sector, had just invested huge amount in its new expansion. Due to huge capital investment, the company is in the need of additional 1,50,000 in working capital immediately. And you're talking about three possible sources of working funds. And the requirement is which alternative should the company select? I think everyone agrees that you would definitely go with the alternative with the lowest cost. So let us calculate the cost quickly for each one. First one, bank loan. The bank will lend 2 lakhs at 15%. A 10% compensating balance will be required, which otherwise would not be maintained by the company. Can anyone tell me what will be the cost for this avenue? I think if you're talking about 100 rupees, out of 100, you are supposed to keep 10 in the bank. You are actually getting 90, right? Whereas you're paying the entire interest on the 100. So interest is 15, you're getting 90. That should be your cost. I think this should be roughly around 16.67%. Because there is a compensating balance, guys. So if you're talking about 2 lakhs, you guys can do that as well. If you're talking about 2 lakhs, you're paying an interest of 30,000, but you're actually only talking about 1,80,000 here. So this gives a 16.67%. So the bank loan is costing you 16.67%. Let's talk about the trade credit. Can anyone tell me the trade credit here? 3 by 30 net 90. So we will discuss this also. 360 upon 90 minus 30 into 3 by 97. If I'm not wrong, guys, can you just quickly check the calculation part here? So we're looking at a 360 upon 60 into 3 by 97. I think someone measured that it is 18.5%, I guess. That's option number B. So guys, out of option number A and option number B, can we reject option number B? Probably. Because this is something which is higher than option number 1. Can we do that? Everyone okay, guys? First two are clear to all of you. Can we move to the last one? Now, the last one is factoring. That a factor will buy the receivables of 2 lakhs, which will have a collection period of 60 days. Factor will advance up to 75%, and basis at the interest of 12%, and the commission of 2% is charged. Right? And they're saying that the factor services will save the company expense and bad debt of 1250 and 1750 per month respectively. Wow. So that means 3000 per month is my saving, I guess. Amazing. Okay, so can you tell me in terms of the commission charges, what is the annual commission here? We're talking about 2%, right? So 2% into 2 lakhs is what? 4,000. But we are talking about for 12 months, so 48,000 commission will be charged. Am I correct? And the savings will be 3,000 into 12, 36,000. Any other cost we're talking about? Interest we are yet to calculate. Interest we are yet to calculate. But can you agree with me? But that probably, Smita says first point. Smita, in first point, there is a compensating balance. Compensating balance means you're supposed to keep the balance in the bank. So even if you're getting 2 lakhs, you cannot spend 2 lakhs. You can only spend 1,70,000 because 15% of 2 lakhs is 15%. 30,000 you have to keep in the bank. So effectively, we are talking about how much? No, sorry, 10%, not 15%. So 10% is the compensating balance. So basically, we are talking about out of 2 lakhs, you have to keep 20,000. So you can only spend 1,80,000. You can only spend 1,80,000. So they're getting it. And that is why my effective interest rate cost is high. Although my interest was 16.7, but my interest was 15%, but my effective interest is 16.67 because you cannot use the entire 2 lakhs. You can only use 1,80,000. Okay, guys, if the commission is 48,000, my saving is 36. Can I say that my net cost is 12,000? And then I have to also charge the interest. So let us say, what is the interest factor given to us? What is the interest factor given to us? 12%. 12% is given to us. Am I correct? Interest is given to us is 12%. Then there is a 12,000 cost of net commission. So commission cost is 12,000 divided by 1,50,000 because that's what they are telling you. Is it 8%, guys? So 8% is a net commission, 12% is net interest. That means the factors is giving me a 20% here. Factoring cost is 20%. Hence, you can very well say that this company, Alliance Limited, should go for option number A here. Because that's the least cost. 16.67, 18.56, and 20%. We are talking about a selection of point number 1. So you guys can quickly check your answers. I guess should be doing good. In the meantime, a lot of you guys get comfort level on this particular question. I think Banzedi was asking me earlier, any tips for the exam? Banzedi, the tips for the exam is practice, practice, and practice. Now is the time, guys. Of course, I don't want to start a speech of Shah Rukh Khan of wo 70 minutes, but probably I think you guys can think of wo 40 din. Am I correct, guys? It's not in minutes. You can actually talk about those 40 days. I'm talking about what you have till the end of October. And also the point that being festive season, I request everyone to stay safe. You have your priorities. Life is there ahead of you. I'm sure a lot of you are practicing and studying so hard. I guess you need to realize that if at all, at some point you feel tired, if at all you feel that, okay, this is actually end of it. This is actually not the end. This is the beginning, guys. If you feel the darkness, always remember there is light at the end of the tunnel. Just keep on moving. Have a leap of faith. Never say, no, or never say die attitude. That's something you need to develop. I always believe in one factor that if you do your hard work, leave the rest to the God. I think you will do your best. Never worry about the results. Put in your best efforts. The only person, I would say, who would be, you will not be able to lie is yourself. If you want to evaluate yourself, how you are doing in performance, look at yourself in the eyes, in the mirror. You will get the answer. What kind of efforts you are putting in. So guys, hereby I wish everyone all the best for your upcoming examinations. It was wonderful to be partnering your journey in entire preparation, especially with respect to 3 important pillars of financial management, with respect to cost of capital, investment decisions, and working capital. I'm sure you guys will definitely do your best. Now is the time. And I'm sure just go ahead with your 110% of dedication. And always remember, it's your hard work, discipline, and dedication that will definitely pay off the results in the long run, guys. So students, wish you all the best of luck. Take care, keep safe, and happy learning always. Cheers, guys. Bye-bye. Good night.